To have you here on set.
What a location.
What a location.
Yeah.
It's been a great day. What a day in the market.
Yeah.
Is it as simple as watch yields and then you see what stocks are doing because it's correlated very much? Yields fall, stocks rip.
It's so funny when you walk around here and you talk to people who come from different disciplines on Wall Street, different investment styles. Everyone has their own answer to why the bounce. You talk to a technician, they'll tell you it's a DeMark count. It's 13, counts or whatever. You talk to a bond person, they'll tell you, well, the yields are giving you a break today. It's really the first time that fever is broken. Look at that drop in the 10-year. Look at the drop in the 2-year. All of a sudden, it's one day out of the last 25 days. You don't have to worry about the effect of higher interest rates, and then you look around and say, what do I buy? But now you also have stock-specific news in both directions. Mm-hmm. Apple is notable. According to my team, the S&P's gain would have been one of its best one-day performances in the last couple of months if Apple were just doing what the overall market is doing. But it's actually a detractor. It's such a big stock. It's 7.5% of the S&P. So if Apple were playing along with everyone else, today would have been a much bigger up day. And Netflix. And this is not necessarily a market leader. It's kind of its own story. But that is one of the hardest hit spaces. Communications services, that's the worst group of the year. Netflix is one of the biggest market weights in that group. And this is noteworthy that a company could actually have fundamental news to drive the price higher that has absolutely nothing to do with Jay Powell. And I think for people in this market, that's a refreshing development.
You don't often see Apple, for example, go down, a couple of, and now it also closed off of its lowest levels. But you don't see often Apple go down the way it did and the Dow finish up the magnitude that it did. So your point's well taken. But how much of this, and I know people are pointing to this intervention in the UK, how much of it is, we know it's taken pressure off of the system, but how much of it is also like, okay, it took something about to break in a market for a central bank to flinch. It's a precursor of what might happen here. They flinched, we'll flinch.
Well, if and when we flinch, I can't tell you what the effect will be 3 months out, but I can tell you the day of, this would be like a dress rehearsal. So I think you make a very good point. Like, if people are sitting on the sidelines and they're saying, what happens if there's only two or three more rate hikes and that's the end of it? Do I have enough exposure? No one's really been thinking that way until today. So I do think the return of QE absolutely is giving people a reason to think twice.
Right. People are, have been so intent on thinking about QT and the implications negatively so for stocks, some would suggest, of that. I mentioned at the top of the read here, the differing views, if you will, here at Delivering Alpha, or at least somewhat, and they're nuanced, of course. Stan Druckenmiller talks about a hard landing, if not worse, next year. I had a conversation a short time ago with Citadel's Ken Griffin. Wasn't as negative, and maybe wasn't as negative as perhaps I thought he might be. Here's what he said. Let's react on the other side.
It's a very uncertain time. We're grappling with the threat of nuclear war in the Ukraine. We're grappling with unprecedented central bank interventions. We're grappling with record high inflation in the United States in our lifetimes. So we're in a very uncertain time for investors. And fortunately, the U.S. equity market, although down quite a bit for the year, is showing a level of resiliency. And the U.S. economy, most importantly, is still strong for people who are going to work every day.
Certainly did not give you a sky is falling point of view. He did note the strength of the consumer, and maybe that continues in how the stock market's been so resilient.
So, all right. So I would just start by saying, like, if your expectation was you were going to come here today to the beautiful glass house on the west side of Manhattan, and Stan Druckenmiller was going to give you the warm and fuzzies, that's like you go to see Dolly Parton and she doesn't do Jolene. It's like, what did I come here for? So that's what you're getting in that session. There's nothing wrong with it. I've been watching it for 10 years. He's one of the greatest of all time. And he's giving you the bear case in as eloquent a way as you're going to get it. What Ken Griffin said that was most interesting to me, and I think has the most ramifications for most people watching this program, is the return of the 60-40 portfolio.
Yep.
Keep in mind, this is an alternatives guy. He's not pitching a 60-40 portfolio, and it's very rare that you'll hear a hedge fund say, no, actually, that's going to work. That's pretty good.
Well, at a time when people are questioning whether it is the right strategy anymore. Not only did he not suggest it was the right strategy, he said this was a great time for it.
I'm so glad he said that. It's something that I think I've been trying to say. I don't say it as well as he says it or as succinctly as he says it. But what would you rather? You have a bag of cash. What investment environment would you rather walk into? 1 year ago today, the 1-year Treasury is 7 basis points in yield. Effectively, net of inflation, you're paying the government to hold your money. And stocks are selling 24 times earnings. Now you got a 15.5 forward PE, and on the 40% side of a 60-40 portfolio, you actually are earning a rate of return that could be above CPI. So positive real rate of return on the 40 part. What were wealth managers saying to their clients about the 40 part of a 60-40 for the last 3 years? They would say, well, at least it gives us optionality. At least it's ballast for the portfolio. You would have to wink to talk about the 40 part. Not so anymore. 4% in yields, real rates of return coming back. Looking at taxable equivalent yields in muni bonds, somewhere close to 6%. Looking at corporate paper at 5% plus. We haven't had a situation like this in a very long time, and I was glad that Ken brought that out.